Good morning. We haven't done the mic check yet, but it sounds good. Everyone can hear me? Good? All right. If I stand too close to this one, we'll have double mic action. Trying to avoid that. All right, let me get set up here really quickly. First of all, I got to do my thank yous. I want to first thank CIAS for inviting us, and also thank you for just existing. We're incredibly honored to be partnered with CIAS. We think that our values align with a lot of their values. They're about education and in getting the right tools in every investor's hands. And that's what TD Ameritrade really stands for as well. So thank you to CIAS for, of course, putting this on today and just existing and doing everything they do all year round. Secondly, and maybe most importantly, thank you to everyone here for coming. It's Saturday morning, just after 9 o'clock, and it's beautiful out today, and you guys are here inside with me. But this is a great auditorium, comfortable seats. Please don't fall asleep. We'll try and keep it exciting today. I've just got about 30 minutes, but I'm going to do what I think is a pretty exciting demonstration. Of course, we got topic right there, spread trading for high probability using minimal capital. All right. Quick little introduction here. So I just want to just make sure everyone's aware of what TD Ameritrade is before we get started. TD Ameritrade was founded over 40 years ago in Omaha, Nebraska. What do we all think of when we hear Omaha, Nebraska? Mr. Buffett, right? Warren Buffett, Berkshire Hathaway. We have nothing to do with Berkshire Hathaway, just a coincidence. But when you mention the state of Nebraska on the other side of the planet, I just don't think people know where that is. So I just got to relate it to something that might be, investors know what that is. So founded in Omaha, locations also in Dallas, in Chicago. Myself, I was hired actually by Thinkorswim 10 years ago. Thinkorswim is a Chicago-based options brokerage firm founded by two former floor traders, guys that were in the pits, using the hand signals and trading all day like that, stinking up the place. But really smart guys who saw the future and saw the future was in retail. And they said, we have all of these tools in front of us. Let's make a platform for free for the retail investor to get all the advantages that we have. So they developed Thinkorswim. TD Ameritrade, of course, saw the benefit of that and purchased Thinkorswim. And so I'm headquartered, or was based in Chicago, just moved to Singapore about 9 months ago. So I'm brand new here. Thank you. You guys all have been very nice to me and my wife. We love being here. But like Leanne said, I have been doing a lot of these things over in the U.S. and great things in the U.S. But one thing I've noticed here with the Singapore investor is you guys are very engaged. You ask questions because you care about it. You're not just filling up your days. And I'm not trying to disparage the U.S. at all, but you guys, your time is valuable, your money is valuable, you care. And so what I've really noticed here, and I'm really excited about all these presentations that I've been doing here, is that I'm speaking to an engaged audience. So again, a little bit about the program today, what we're going to be covering. Just got a couple learning objectives up here. I didn't realize that I have this massive screen. I could have used a little bit more here. But we want to determine which option strategies give us better probabilities of success. I mean, that's really what it comes down to. We got to give ourselves a chance here. We want to make it better than a coin flip's chance that we are going to be profitable on our trades. We want to achieve a clear understanding, the difference between a single option and a vertical spread strategy. So sometimes I kind of maybe take it for granted that people right off the bat know what an option is, know what a call option is. So really quick, brief description here. A call option gives the owner the right to buy 100 shares of stock at a predetermined price before a certain expiration period. We're not going to get too much into put options. I think the easiest thing is just to discuss call options at this point and talk about those strategies. So when you buy a call option, you pay a premium for the right to buy shares at a predetermined price before a certain expiration period. Great advantages to that, but there's also great advantages to spreading off those trades as well. And then the last one here, kind of a little bit redundant maybe, ensure high probability is considered when selecting option strategies. I've been talking to a lot more customers recently too, and I've noticed that maybe they just don't know where to start. They say, okay, I open up your option chain, I'm looking at McDonald's, or I'm looking at Apple, and I can see all of these expiration dates. Where do I start there? Okay, we'll talk about that. All right, when I open up that specific expiration date, I see all of these calls listed here. Which one do I choose? This one's expensive, this one is cheap. Which one do I choose? Okay, so that's what we're going to do. We're going to basically kind of narrow it down and kind of maybe give you a little tips about what we look for, at least what we teach our clients to look for when looking for option strategies. All right, Oh yeah, and then I also have just a couple agenda items here, just a couple like kind of buzzwords up here, things that we probably will touch on a little bit, things we might not be able to get to, but I'll use this opportunity to maybe plug myself and my company a little bit more. Of course, we have a booth out there, just like everyone else here presenting today. We have a booth. I really encourage everyone to come up and ask us questions. We've got very knowledgeable staff there right now. We're going to be there all morning and most of the afternoon, so please come ask us questions. I see some people already got a monkey, which is awesome. That monkey is brand new. We just got those things shipped from Chicago. He has a name. His name is Zeppy. We invested so much money in marketing and research to find out what to name this guy. And the little monkey mascot name is Zeppy. He's actually a real person. Zeppy is a former floor trader. He had the letters Z-E-P, Zeppy. So he's actually on the Thinkorswim trade desk too. You might have talked to him if you've been a Thinkorswim customer for a long time. But yeah, so we've got a lot of educated staff over there. Please go ask them questions afterwards. Also, I'm going to be there. In addition to that, every Tuesday and Thursday, I do 1-hour platform demonstrations. Not always me. Sometimes I'm a man. Leonard down here in the front row, he will be doing them too. So those are all online. You can find those on our software. In addition to that, really important, in person. I found the Singapore investor also likes talking to people face-to-face, which is very nice. They also like asking questions face-to-face. Sometimes over chat is not the easiest to convey what you're trying to do. So this Wednesday, in our office here in Singapore in Millennia Tower, we're doing a 2-hour platform demonstration from 7 to 9. I want to invite all of you guys who are all invited. We only have room for about 60 to 80 people, but I'm not fooling myself. I know you're not all going to come. But I just want to throw it out there. If you're interested, come by our booth. I'll give you my card, all that information. Platform demonstration. Again, it's free, no obligations, nothing like that. Just come, ask us questions. All right. So getting into probabilities. So easiest way to think about probabilities is the old coin flip. I've got that up here. You flip a coin, 50-50 chance it's going to land on heads or tails. We all know that. Even if you flip it and it lands on heads 20 times in a row, that 21st time, there's still a 50-50 chance it's going to land on heads or tails. The odds don't change. When you think about the stock world, the investing world, if a stock, you don't know where it's going to go. We all don't know the future. We can't predict it, right? So we don't know if it's going to go up or down. So in our heads right now, when we think about it, we think about 50-50 chance it's going to go up or down. Well, there's a little bit more to it, of course. People found out you can make money in investing and trading, and all the mathematicians crunch these numbers here. So there's things like standard deviations, normal distributions, and mean averages, stuff that's a little bit beyond our scope today. But I just want to explain that there's math behind how we come up with these probability numbers. So, when if a stock goes down $1 each day for 20 days in a row, that 21st day you wake up in the morning, are you thinking it's a coin flip at that point? It goes down 20 days in a row, $1 each day, 20 days in a row. Do you think, man, it's probably going to go down again because it has been going down? Or do you think, hey, it's overdue for a correction, it's going to go up? 50-50 chance. That's where a lot of these probabilities will come into play here. So to get into how probabilities are kind of calculated, I want to just talk about 2 brief things here. First one, not so brief, but then the next one, very much so. So the first one is volatility. I got this cheesy graphic off the internet, but I kind of like it. It's got a question mark there at the end. It's just basically almost like any kind of chart or cardiologist report. But we're kicking here. The stock's been moving, and then we're up to current time, and we don't know. There's the question mark. We don't know which direction we're going to go. But what we do know is where we've been. We do know where we've been in the past. And so we can use probabilities to kind of give us a figure of like, well, I think there's an X chance that we are going to go to this level or that level. Think about it this way. What are the chances, any stock, doesn't matter, what are the chances this stock is going to be $45 a share or higher by this expiration date? Well, if we look in the past and we say, okay, well, it's traded between 35 and 40 in the past 3 months. That's been its range, 35 and 40 for the past 3 months. What are the chances it's going to hit 45? You might think not that likely. It hasn't been there yet, and it's actually kind of far away, $5 away from its range in the past 30 days. But another stock, same question. What's the chances it's going to be at 45 in the next couple days? Well, in the past, it's been in the range of 30 to 50. It's been in that 30 to 50 range. So you could think there's a greater probability that that stock will hit that level by that expiration point. All right, that's basically what volatility is to me. People often ask that, how do I interpret implied volatility? How do I give it a definition? And I say, just think about how, and I hate using the word that I'm trying to define in the definition, but how volatile a stock is. How much does it move up or down? How much has it done that in the past? I did some screenshots yesterday. I think these numbers are still pretty accurate. I just chose these two companies. This is our software, by the way. We will be diving into this more interactively here in a minute. And I actually chose the light background, so it might be a little bit easier to see when we load it up here. But still, I just took these screenshots here. We're looking at two stocks, McDonald's and Apple. Everyone knows them, big multinational companies. But I chose them because they're almost the same stock price. You see that red box I have outlined? They're both around $159 a share. All right, both around $159 a share. And then if you go down here below the price, we say September 15, September 17. That's the September expiration. It's got 3 weeks to go before those particular options expire. And this number, I also highlighted over here in red. There's two numbers there. And then this is a common question I get, and I want to kind of highlight it because I think it's a really cool tool here. They're both different. There's first of all a percentage. That percentage is the implied volatility of that expiration. Now you see it and it says, okay, you tell me it says 14.56, this was 24.81, good, what does that mean? What does that mean to me? Is that percentage, is that probabilities? I would say don't focus so much on those percentages. What I focus on personally as a trader is the number right after that. In parentheses, there's a number, and it has a plus minus sign right in front of it. Of course, because what it's telling us, this is considered market maker move, it's telling us that there's a chance it can move up or down by that amount based on what we know so far. So this is, I've been pressing the developers for this. I said, what's the formula for this? They said it's proprietary. I said, okay, well, I work for the company. And they said, no, you wouldn't understand. I'm like, okay, I kind of believe you, actually. So but what it's based on here is, I kind of mentioned the founders of Thinkorswim and Zeppi. These guys are all former floor traders. Back in the 80s, in the early 90s, they didn't have these fancy computer things spitting out these numbers for them. So what they had to do is they had to read the room, because there's a big room of traders and everything, and they could see the option prices too. They could see the prices for the options. They could hear markets. So they had to kind of figure out, what is the market expecting a move by a certain period? So what they would do is they would take the at-the-money straddle. If you guys know what a straddle strategy is, it's a call and a put at the exact at-the-money point. So in this case, it would be the 159 straddle. They add those prices together, and that would be close to what the market was expecting the stock to move by that time. You don't have to do that anymore. We spit it out here for you. Now, this is not exactly the at-the-money straddle. This is, again, our own proprietary formula. But you can see here, McDonald's has, what, $4.50 move by that September expiration, where Apple has almost $8 move by that expiration. So two stocks, same price, have expected moves drastically different, almost 2 times different. And the reason why is, I pulled up some charts yesterday too, and I kind of typed it out here. Right below the McDonald's screenshot here, the previous 3-month range was 149 to 159. So it's only moved in the past 3 months about $10, give or take. And then Apple is much greater range. The past 3 months traded between 142 and 162. And the reason why I chose 3 months is because, of course, the most recent activity is more important to us as traders. We don't really care about what it did third quarter 2016, for instance. So just use these 3 months here. So that kind of gives us a better understanding of, okay, well, that's how volatility is kind of calculated. This Apple chain right now has greater volatility than the McDonald's one, not exclusively because, but a big reason because of the range it's been in. It's a more volatile stock. Even though they're the same price right now, they're more volatile for Apple than McDonald's here. Okay. Next one, time. Just got a blank one here. So time is also a big factor for probabilities. Obviously, the more time you give the chance of something happening, the better chance it is going to happen. When it comes to investing, that could be very important for us. There are things like earnings announcements, product launches, and management change, U.S. political turmoil. I won't get into that. We're talking about trading today. But the more time you give for a certain thing to happen, the better chance it will. So all these things go into our probabilities. My point in bringing all this up is that we're going to now dive into some probabilities, where to see these on the Thinkorswim platform and how to interpret them. All right, so let me, I'm pretty sure that's it. There we go. Just bounce over to my software really quick. Maximize this screen. All right, like I said, we went with the light background. I think it's a little bit easier to see. So on Thinkorswim, we provide formulas, and I shouldn't say formulas, the answer to the formulas, the result of these formulas for probability in the money, out of the money, and at the money. What those things mean, of course, is when we talk about an option chain, and this is something I kind of wanted to clarify, and I kind of skipped over here, but when we say moneyness, in the money or out of the money, it has nothing to do with profitability. I think sometimes beginners, at least, kind of mistake that. They say, oh, I'm in the money. That means I'm making money. And not necessarily, because you could be long, you could be short. There's all these different factors that go into it. But basically, again, just talking about calls. Stock is $100. Let's just look at the range. It can go to 0. It can go to infinity. But let's just talk about between 90 and 110. We have that huge range here. Dollar increments, all right? Dollar increments from 90 to 110. And it's trading at $100 right now. For calls, anything lower than the stock price is in the money. That's considered in the money. Higher than the stock price is going to be out of the money. And then at the money is right at the current stock price. That's going to be 100 right there. So when our probabilities come up on the screen here in a minute, that's what we're talking about. Probability in the money, out of the money, or at the money. So let me go over there right now. I'm going to actually use my Analyze tab, because it's just like my Trade tab. It gives me stock prices and option chain here. I love the screen. This thing is so big. So hopefully everyone can see it. Again, if you can't see it or just want to just review this stuff, we're going to be over in our booth here all day. And then come Wednesday night for our demonstration too. But I'm just opening up the, actually, you know what I'm going to do? I'm going to open up the October 6th option chain. The reason I chose this one here, and again, this is kind of people want to ask, well, I personally like doing a couple different strategies. I love the vertical. I love the spread trade, whether I'm buying or selling. I do both. I buy and I sell, but I don't do it so far out. There's these options called leaps, which are all the way down here, that just have so many days left to expiration. Look at 511 days left to expiration. I don't even mess around with those ones. My sweet spot when I'm trading options is anywhere between 21 days and maybe 70 days, 70 or 80 days. Between 21 and 80, I would say. That's my sweet spot when I'm trading options for this particular strategy. The reason being, if I go any shorter than 21 days, there's not much premium in those options. All right, there's not much left in those. So I just want to give myself, a little bit of juice in there. All right, and so I just chose these October 6 ones, mainly because they have $2 increment strikes. I noticed, I believe these monthlies only have $5 increment strikes. So another one here, notice I'm looking at the strikes here. Up and down the middle of the screen. $5 increments on the monthly options. These weekly options have $2.50. Just gives me a little bit more flexibility to control my risk appetite on these ones. But okay, let me load the probabilities really quickly here. Right now we see, again here, just really quick, we're on the calls on the left here. We're not going to talk about the puts over on the right. And the stock price is running up and down the middle of the screen. I'm going to view a couple more strikes. There we go. So we can see all of these prices here. So again, back to, well, how do I know which one to choose? How do I choose which option to trade, which one to buy, which one to sell? These ones here, they look kind of expensive. These ones are very cheap. We don't have any probabilities loaded, so let's do that right now. I'm going to click on this layout button, and I'm going to customize. I'm going to make my own layout. So I'm going to get rid of what's in there now, and I'm just going to look for probabilities. There we go. I just typed it in. I got all three of these. Not sure if I'm going to have room for all three of them. If so, I'm going to remove touching, but let's just try this. Now, there we go. We can see it pretty well. Got our probabilities up there. All right, so probability in the money, out of the money, touching. Let's just focus on these two really quick. Obviously, probability in the money, meaning anything, again, with calls, lower than the current stock price is in the money. So we see the highest one is the deepest in the money, 85% chance. That particular call, this 149 call, 85% chance, this is going to be in the money at options expiration. And in options expiration, October 6th for this one. All right, now we go further out here. The 170 strike call, only a 4% chance. That's going to be in the money at options expiration. All right? So obviously the inverse for probability out of the money. Now, probability of touching, that's kind of an important one for people's risk tolerance. How comfortable are you if you're in a particular strategy, if the stock actually reaches a certain point when you might be in a losing position? So probability of touching just says at any time between now and the options expiration, at any time, what is the chance that this stock price is going to hit this level? So obviously we should see the highest point right at the money right now and then falling off on either side. All right, I had a couple trades that I wanted to kind of pull up here, just give us an example of how we can use these probabilities and harness them for our best trading opportunities here. So I want to just focus right here at the money, close to at the money, the 157.5 strike call. Let's just talk about buying this call. What's it going to take to buy this call? So I just clicked on the ask price, and I'm going to give myself, so notice how there's a spread here, decent sized spread too, 274 by 355. Well, I think I could probably get this trade done at $3. Let's just call it $3. Okay, so probability that it's going to be in the money at expiration is 55%. That's more than a coin flip, right? Everyone would agree? We're giving us more than a 50-50 chance that this is going to be in the money at expiration. But the problem with just stopping right there is that we don't want this to go just to 157.5, which is what this probability is telling us. We need to compensate for the premium we're paying for the right to buy these shares at that stock price, at that strike price. And what are we paying? We're paying $3. So we have to add $3 to our strike. We get just over 160. So really what we want to look at when determining the probability for this trade is the next strike up. It's the next strike up. It's that 160 right there, right? Because our break even on this is north of 160. It's 160 and 50 cents. So really, our probability of success on this one is only right around 40%. All right, so now we're less than a coin flip chance on this point here. All right, so if that might be a little bit difficult to remember what I have to do here, we made it easy. We actually have a risk profile. I love the risk profile. It really helped me kind of grasp on a graph where my risk and my reward lies. So on this graph here, you see two lines. Let's just focus on this green line. This green line that's got that sharp angle. That's my profit or loss at expiration. On the left-hand sidebar, this is my P&L, potential P&L number. We have a zero line right here. That's where we break even. Anything lower than that, we lose. Anything higher than that, we start making money. And then here's the stock price at the bottom of the screen. Okay, I'm going to show how to really kind of harness this to really grasp the probabilities here. We do see some probabilities up here, but it's not telling us anything. It's 100, 0, 0. So what I'm going to do here is I'm going to change my slices. So I'm going to click on this button right here, go to Set Slices to break even. So I just changed it. I'm now at break even. What was my break even? Well, we just said it earlier. It was about 160.50. So now it gave us that chance right there. We just got that one slice right in the middle. We could see, obviously, that's where this line intersects with the zero line right here. So that's our chances of, or that's where it's going to break even right here. But we still see 100 and 0. And the reason why is that our date is set to today's date. Of course, there's a 100% chance it's going to be below 160.5 because it already is. So let's just change this date to our expiration period. There we go. Now we're seeing our probabilities up here at the top of the screen. And if you're kind of a nitpicker like I am and you want the exact number, because when we look at the option chain, I said, hey, look at the 160 strike. That'll tell you probability in the money. Well, our break even is higher than that. Our break even is 50 cents higher than that, as a matter of fact. So this is telling us now to the T, that's what our probability is of making any money on this trade. Of course, probabilities will change as the market changes, but right now, today is all we know. Let's just focus on our knowns. All we know is right now, today, where the stock is and where it's been. So that's our probability of making any money on this trade. Now, the other part to this equation is doing this with minimal capital. How much is this trade going to cost us? Well, right now, I can pretty easily see in the lower left-hand corner, well, you can't see that really well on the screen, but it says 3,000. Let's just do the math real quick. When you pay $3 10 times 100, that's 3,000 US dollars right there. So that's our max loss, all right? This is not including commissions, too. I need to preface that. This is excluding commissions. Our max loss is $3,000, so we're putting up $3,000 for a 40% chance of making just anything on it, just making a penny on it, all right? So again, is that capital, can it be used better? Can we give ourselves a better risk-reward ratio? So right now we're risking $3,000. We have unlimited potential on the upside, but there's not that high a probability. And that's where the spread part comes into play. All right, so let's look at another one. A spread trade, as a matter of fact. So what we're going to do is we're going to still buy this one, but let's also sell the next one higher. So a combination of buying and selling options is what a spread is. What we did here is we bought the in-the-money option and sold the out-of-the-money option, the 160 strike. So we're basically kind of spreading the stock price right now. The stock price at 159, we're kind of on either side here. And we could probably do a little bit better than that. I always like to make the market makers pay me instead of me paying them. So I try and be a little more aggressive with my trades here. So I've got this spread trade built now. And this one, again, before we go over to the risk profile tab, this one should, let's just do the math beforehand. When we pay 125 10 times our multiplier of 100, should only be $1,250 as opposed to $3,000. Let's go check it out. So I'm going to go to my risk profile. And as a matter of fact, there it is. So our max loss now is $1,250. Max profit up here is the same thing, $1,250. So now we gave ourselves a better risk-reward ratio. We're 1-to-1. We're risking one to make one on this trade. But let's talk about probabilities now too, because they changed. Because now we're only paying $1.25 instead of $3. We don't need the stock to go to 160.50 to make money on this. What is our break even now? Again, just by simple math, we know by adding our long strike to our debit, that's how we can get there. But if we don't want to do that, let's just make the system work for us. Let's go to set slices again to break even, at expiration. There we go. So now our break even, 158.75. Do you like that a little bit more? Because look at the stock price right now. It's already higher than that. We're already breaking even. By putting on this spread trade and not just doing an outright long call, we're at our break-even point. What happened to our percentages? They also changed. We also increased our probability of success from below 40 to almost 50% on this trade. All right? So, I've been doing these a little bit here too, and I notice a lot of people when they talk about options, they like talking about, oh, you should only sell options. Only sell options. That's the only game in town. I hesitate to say use any definitive words like only and promise and stuff like that. In fact, I never use them. So what I will say is that selling options is right for some investors. Buying options is right for others. If you have a bullish tendency, the topic of today's whole session is bull market, bear market. What does it mean to our portfolio? The thing with options, it doesn't matter. We can put a position on to profit from either way. If you have a bullish tendency, you can buy options, and you can limit your risk. And you can do it for minimum capital. We just slashed our capital in half. We'd only have to put up a little over $1,000 instead of $3,000 for this trade now. All right, but I do agree with people. There are benefits to selling premium too. And so let's talk about that real quick here. I know I've got just about 10 minutes to go here, but I want to just make sure we have time to talk about selling options as well as looking at a probability analysis cone. All right, so I had one queued up here. Let's look at 162.5. So when we sell an option, what are we doing? We're giving someone the right to buy the shares from us. That means we take on the obligation to sell the shares at the strike price. All right? And so when I went out of the money just a little bit here. So again, if we're of the tendency to say, okay, over the next 42 days, and especially by October, we think McDonald's has been on a large run-up recently. Maybe it's not going to hit 162.5, and by October it's going to be below there. So I want to sell this option and collect that premium. Okay, we'll do it. Click on the bid price, pull up a sell order. And again, there's a decent spread here. I want to increase my premium. There we go. Okay, so let's look at the probabilities on this one. 23% chance it's going to be in the money, or conversely, of course, 75% chance it's going to be out of the money. So all of a sudden, our 50-50 talk has now really changed, hasn't it? We're giving ourselves a 75% chance of probability. That's fantastic, right? That's way better than 50. So we're giving ourselves 76% chance of probability, but also look at this probability of touching. It's almost 50%. Now the reason I bring this up with this particular strategy is it's a fairly risky strategy. Not fairly. It's the riskiest strategy to sell a naked call. That's what this is. This is a naked call here. We're giving someone the right to buy shares from us at $162.50 at any time between now and that expiration period. Yeah, right away, when I sell it, I collect that 75 cents times 10 times 100, $750 in my pocket. Now, it's not profit, but by the time the option trade plays out, possible that the trade expires worthless, and then I get to keep that. But conversely, think about the downside too. Look at this line. It bottoms out to the left here. It can't go any further higher. It's plateaued. That's our max profit, $750. But what can it do? Look at that slope. The higher the stock price goes, the more I keep losing. There is no cap on how much we can lose on a naked call. So the reason I bring this up is that it ties up a lot of our money. Now, there's not that great of a chance that the stock is going to move up there, but crazy things happen. You know, McDonald's is a very steady blue chip stock. Big news would have to come out for it to move this high, but it happens. It happens. And so the reason why we hold so much money is because it can happen. So what I did here is I just opened up the requirement for this position. Look at that, $28,800. So we were talking about buying outright options. When we bought the outright options, we just have to pay how much it cost at that point. All right, we just have to pay that. It was $3,000. I said that was too much. Let's cut it in half. Let's do $1,250. Look at this strategy. Just to collect $75, we have to put up almost $30,000. That's not efficient in my book. So that's where the spread trade comes into play. Instead of just selling the 162.5, we're going to pair it off with the 165. So I'm just going to add this leg by clicking on the ask price. There we go. And let's try and get a little bit more from them, about 50 cents. So now, did you see what happened to this figure when I did that? It changed drastically. It went from 28,000 to 2,500. And we're still kind of in the same position. We still have the same probabilities because we're still short the 162.5. We still have a 76% chance that it's going to stay below that figure. Now, what did we give up, of course? We gave up a little bit of premium. Instead of collecting $750, we're collecting $500. But this trade still has 40 days to go. Why tie up so much money for that long a period with that much risk? Are you going to be able to sleep at night knowing that you can lose that much money? Well, in this case here, the most we can lose is the difference between the strikes. We protected ourselves. We bought ourselves the right to buy the shares back at 165 here. So we're only limited to the difference between these strikes, minus the credit we received. So $2 here. So we're risking $2,000 to make $500. Pretty simple, right? We're risking 4 to make 1. So different than our previous one where we did risk 1 to make 1. In this case, we're increasing our probability. We have such greater probability now, but we have to give something up, and that's our risk-reward ratio here. All right, before I wrap up here, I just want to talk about one quick thing on this Analyze tab that a lot of people, I think, maybe either don't know that it's there or maybe apprehensive about using because it might look a little confusing. And what it is, it's the probability analysis. It's our probability cone. All right, so we're talking about probabilities, kind of like, tie it into the beginning of the session here. What are the probabilities? We saw that volatility graph from the question mark and up and down. Which way is it going to go? Of course, we don't know which way it's going to go, but what are the probabilities that it's going to go up a certain amount or down a certain amount? That's exactly what this is right here. So I'm just going to reset my slices really quick. There we go. Okay, so the current stock price is right below 160, and that's today. This is time down here on the x-axis. And then stock price on the y-axis here. And then we have this probability cone. spitting out numbers, telling us what's the probability it's going to be within this range by a certain period. And we don't have to go all the way out. We can actually zoom in here. What were we talking about? We were talking about the October 6th options, which are right here. Again, just over 40 days to go here. So this graph is telling us, based on all the things it knows, standard deviations, mean distribution, it's predicting the stock to be within this range, 150 to 166, okay? So now, of course, the percentages and probabilities change as you get closer out to there because it's all kind of like a distribution from the current stock price. But this chart right here can be really, really useful when harnessing and trying to grasp, okay, what's the range it's going to be in? If I'm going to be selling premium or buying premium, what are the probabilities of that particular trade being profitable? Okay, I do have to wrap it up. I do want to say, again, we have a booth here. We'd love to talk to you guys more about this stuff. We have our software loaded up there if you want to ask specific questions about the software. Also, again, demonstrations live on our software. You can access them on the paper money side every Tuesday and Thursday. And then this Wednesday night from 7 to 9 at our office in Millennia Tower, we're doing a 2-hour platform demonstration and maybe have some extra goodies to give out at that one too. So thank you guys very much. Enjoy the rest of your day. Appreciate it.